First idea, Royal Bank of Canada.
Yeah, you know, it's Canada's largest bank by market cap. And, you know, as I was saying earlier, in this environment with highly fluctuating interest rates, mainly going up, the banks are certainly going to be somewhat sensitive to it. But the Royal Bank, you know, as one of the larger, they have a very, very diversified base of earnings, as do most of the banks. But, you know, they're into domestic banking, insurance, wealth operations. They have global capital markets business. Overall, I think that management's been investing very heavily in maintaining their lead market share through investing heavily in technology and their distribution network. I think the dividend is very safe. You know, the yield relative to some of the other banks, it's over 4%, but it's not the best yield in the bunch. But I think, you know, for someone who's looking for safety in this market, you would do well to invest in the Royal Bank. It is certainly one of our largest holdings, and I think that going forward, we're going to see, you know, more dividend increases out of all the banks, but also particularly in the Royal Bank as well.
Suncor.
Yeah, now Suncor, I think, is interesting. You know, they've been raising a lot of capital lately. They sold their renewables business to Canadian Utilities. They've recently sold some of their assets in Norway, so they've built up a fairly good war chest. It's believed they might be looking at a strategic review of their retail business, although I don't necessarily think that would be a great idea from my point of view, but it's certainly one that some of their more aggressive shareholders are having them look into. And they have now sort of bought out Teck's interest in Fort Hills, which is a big oil sands long-term project, multi-billions of dollars of investment, but a huge resource. So their interest in Fort Hills is now going to go from 54 to over 75%. I guess Total Energy still has the remaining interest. They might be looking at selling it, but now that they control it completely, I think they can do more things to better optimize those operations. And you know, I think over the next number of years, energy is still a highly needed resource, as we're beginning to see this coming winter in Europe in particular. So I think that it's a good time to be in well-priced energy companies, and I believe that Suncor is extremely well priced at these levels.
And Fortis, another consistent dividend increaser.
It is, you know, a diversified infrastructure holdings, primarily involved in gas distribution and electric utilities, and electric distribution as well. You know, they just recently announced their new 5-year capital plan, which has taken their investments up to around the $22 billion mark. So in that 5 years, I think we can probably see additions to their rate base in the magnitude of around 6%. And I think as a result of that, you're going to see pretty consistent dividend increases over those years. Again, they have consistently increased their dividends over many years, but I think we're going to see increases anywhere from between 4% and 6% over the next number of years. So at the current price, I think it's a good company to hold, and a lot of their earnings are in US dollars, so you do get a little bit of hedge against the Canadian dollar from that point of view as well.
Suppose you plan to go and meditate in an ashram for 10 years, and not look at your portfolio. Would Fortis be a decent idea, do you think?
I think it would be, yes. I think, you know, the need for energy and energy distribution, whether it's through gas or electric or whatever, is going to continue to grow.